Alrighty guys, here is the fourth and final topic that will be covered on your final exam. It's topic 3.4, monetary and fiscal policy. This is covered in chapters 28 and 30 of your textbooks. So a little bit of a recap of stuff from 3.3 that we'll cover today. We talked about banks and the idea that they can expand our money supply through lending, how banks create money. Talked about fractional reserve banking, and the way banks create money is through making loans, so that's going to come through again today. And don't forget, in our aggregate demand, aggregate supply model, we had this equation for aggregate demand. It's the expenditure approach. So the total demand for everything in our economy is the sum of all the consumption, C, investment, I, government spending, G, and net exports in X. So we're going to talk about monetary policy first, its impacts and shortcomings. Then we're going to talk about fiscal policy, its impacts and shortcomings. So if we're going to start by talking about monetary policy, we have to talk about the Federal Reserve. So I've mentioned this before, but the Federal Reserve is the central bank of the United States. It's sometimes just called the Fed, F-E-D for short. And so they are the institution in the United States responsible for conducting U.S. monetary policy. So it's not the same thing as the feds, if you've heard that before. That refers to federal agents. But the Fed, singular, refers to this institution. They are our central bank. We say this is a semi-decentralized institution, meaning some of it is a government institution, so they're political actors. So, for example, the chairman of the board is appointed by the president and confirmed by the Senate, so very political in that sense. But a lot of the member banks of the Federal Reserve have some private sector commercial banking representatives representing the interests of certain banks. So we say this is semi-decentralized, kind of like how the Supreme Court is shielded from political interference. The folks at the Fed are not, we try not to politicize the positions at the Federal Reserve because we don't want political monetary policy. Believe it or not, having all government officials who belong to a political party is not a good thing for our economy and our money supply, which we'll talk about a little bit more. So we kind of have this balance of private commercial banks and government appointees. So we say it's semi-decentralized, and that kind of keeps things going smoothly. So what I do want you to know about the Federal Reserve is that it has three main responsibilities. It is our central bank, it also regulates banks, and it conducts monetary policy, which is the focus of this topic, or at least half of the focus. So the central bank, this is job number one of the Fed. So the Fed acts for a bank for banks, which means most of the things that you can do if you were to go to your bank, like a Regions or a Wells Fargo, everything that your bank does for you, pretty much the Fed and the Fed's district banks does for your bank. So for example, you can go to your bank and open an account and store all your money there. And then your bank, instead of keeping their own deposits from their customers on hand, they have an account with the Fed, and essentially they can deposit their reserves there in an account with the Fed. The money that the private banks have, their customers' deposits that they hold at the Fed, we call them federal funds, which sounds like a little bit of a misnomer. The word federal funds makes it sound like it's owned by the government or owned by the Fed, but it's not. So federal funds are the funds that belong to a private bank, like your bank, that are just stored with the Fed. So keep that in mind. So in fact, this entire slide is full of words that are kind of mean the opposite of what they sound like. So there's also this interest rate called the federal funds rate, which is an interest rate on loans between private banks or using those federal funds. So something cool that banks do is a lot of times they will make short-term loans to each other. So if you remember back in the money and banking chapter, we talked about something called the required reserve ratio. That's the portion of deposits that banks are required to have set aside and not lend out. It's usually around 10%. So if you were to deposit $100 at your bank would have to set aside $10, and then they could lend out the other $90, and they've got to do that for all of their deposits. So banks have to have that minimum on hand at the end of every day to meet and comply with that required reserve ratio. So if your bank, for example, had a really great day where a lot of people came in trying to get loans, they might be a little short. Maybe instead of having 10%, they've only got 9% or something like that. And they have to come up with that minimum to meet the reserve requirement. So maybe your bank made a lot of loans that day, but my bank did not make a lot of loans. Instead, a lot of people came in and deposited money, and so they have a lot of excess reserves. They got more than the minimum 10%. So your bank could go to my bank and say, hey, look, could I actually borrow some of your excess reserves? I'll pay you back tomorrow after more customers come in and make deposits. And it'll be a way for you to make a little bit of interest off of those excess reserves you have, because if you just leave excess reserves sitting in your vault tonight or for however long, you're not going to be earning any money on it. So my bank says, sure, here's the money that you need to meet the reserve requirement, and then it's very short term, a lot of times just overnight. Once the bank gets more deposits from their customers, they'll pay it back. So for those little short-term overnight loans, banks will lend to each other at this rate called the federal funds rate. So it's kind of cool. So banks can kind of look out for each other, make sure everyone meets the reserve requirement, depending on how business is going. Now, I do want you to put somewhere in your notes, if you're taking notes, or on your concept guide, if you printed that out, that the Fed does not actually set the federal funds rate. The banks negotiate that themselves. So if one bank is a little bit short, they'll talk to one another. Now, the Federal Reserve can do a lot of things to influence the federal funds rate. So you might hear in the news that the Fed raised or lowered interest rates. So they can take a lot of actions to affect those things, but they don't set it by law, the federal funds rate. The banks just negotiate that when they're exchanging with each other using those short-term loans I was talking about. So that's one job of the Fed. Another job is the Fed itself can make its own loans to the banks. So if you were to go to your bank and you wanted to buy a car or a house or something like that, you could get a loan, and banks can go to the Fed and get a loan directly from them as well. So when a private bank goes to the Fed to get a loan, it's called a discount loan. And on a discount loan, you pay the discount rate. Now, the Fed does set the discount rate because it's their loan that they are making. They don't set that federal funds rate. I do want you to note that the discount rate is higher than the federal funds rate. So banks do not like to go to the Fed for a discount loan. They would much rather borrow from one another using the federal funds rate because it's cheaper. But discount loans and the discount rate is kind of like a last resort. If you can't get another commercial bank to lend to you, you can always go directly to the Fed and pay that discount rate. So the discount rate is higher than the Fed funds rate. And then the last job, central banking job of the Fed, is processing checks. So they'll clear checks from one bank to another between those accounts where the banks store federal funds. So that's important too, is they kind of connect different banks and help the money clear from different accounts. All right, the second job of the Fed is bank regulations. So regulations are rules that the commercial banks have to follow. Most of the rules that the Fed sets are trying to avoid bank runs. So a bank run is when everyone tries to show up at the same time and take their money out, and the bank only has like 10% set aside. So the Fed prevents bank runs a couple of ways. One, they set that reserve requirement. Typically, it hangs out at 10%, but they could raise it or lower it if in times of economic crisis or something like that. And they also prevent the types of investment banks can make. They try to keep them from making excessive risks. So, for example, if you remember, we talked about moral hazard back in the Money and Banking chapter, the idea that because there's FDIC, bank runs are really rare and banks are more likely to make a high-risk investment because high risk means high reward, and FDIC means bank runs are very, very rare these days. So the Fed will step in and go to the banks and say, hey, you can't make this type of risky loan with your depositors' money because you're probably going to lose it and then your bank's going to go out of business. So the Fed regulates that way to try and prevent them. So you can pause the video here. This is a clip from an old film that shows a bank run. This is what the reserve requirement and FDIC and a lot of other Fed regulations are trying to prevent. So hit pause here, go to supplemental video tutorials for 3.4, and you can give that a watch if you want to see. All right, the third and most important job of the Fed is conducting monetary policy. Monetary policy is when you use the money supply in an economy to try and influence it. So there's this type of monetary policy we're going to look at. It's called counter-cyclical monetary policy, which means the goal is to smooth out or counter whatever stage of the business cycle we're in. So it's an attempt to stabilize the economy. This is also sometimes called active monetary policy. In more recent years, the Fed has kind of moved away from this idea of activist monetary policy, but it does tie in with our aggregate demand and aggregate supply model, so we're going to discuss it. So just like there are two stages of the business cycle, there are going to be two types of counter-cyclical policy to counter those stages of the business cycle. So expansionary monetary policy means the Federal Reserve can increase the money supply. So it's actually the Fed that controls the amount of bills and coins that are circulating in the economy. So expansionary monetary policy means increasing the money supply out there. And they would increase the money supply during a contraction or a recession to try to give the economy a little bit of a boost. And then contractionary monetary policy means decreasing the money supply, which is to slow down expansions. And the reason they want to slow down the economy when the economy is expanding rapidly is because it's supposed to keep inflation from getting out of control. So when the Fed was created back in the early 1900s, it said that they had this thing called a dual mandate, which means they had two jobs. One was to try and minimize unemployment, keep employment really high and the economy going along, but also keep control of inflation. So that's kind of the balance between expansionary monetary policy. If we're in a recession, the Fed will try to up employment, and try to make the recession not so bad. And then during expansions, kind of tamp down on inflation as prices start to rise while the economy is expanding. So that's their dual mandate. So we're going to talk about how the Fed conducts monetary policy. They have a bunch of tools in their toolbox, but the most important tool is something called an open market operation, or an OMO. So the Fed controls the money supply. So suppose the Fed wants to increase the amount of dollars circulating in the economy by 50,000. They've got a few options how to get those extra dollars circulating. They can drop the money out of a helicopter. They can distribute $50,000 to every bank in the U.S., or they can buy something in the economy. So this is the option they're going to go with. They buy something. So the question is, what exactly does the Fed buy with these dollars to get it circulating out in the bank and the economy? They buy bonds, essentially. So these are sometimes called treasury bills, treasury securities, treasury bonds, T-bills. They have all kinds of different names that they go by. I'm going to stick with bonds for the most part. So a bond is essentially a piece of paper that says, I owe you money later. And so banks are allowed to buy these from the Fed and sell them to the Fed. So if the Federal Reserve goes to a bank and says, hey, I'd like to offer you some money for these bonds. So the Fed buys bonds. They will hand the banks cash. And now the bank essentially has all of these excess reserves that they can use to make loans. So they do that, and we get more dollars out there circulating in the money supply as that multiplier process takes place. So this is really important. Students get this confused all the time, but I want you to know when the Fed buys bonds, ultimately that is going to increase the money supply. If the Fed wanted to engage in contractionary monetary policy, it could do the opposite. So the Fed could go to the banks and say, hey, commercial banks, I have this great investment for you. It is called a treasury bond. It's a piece of paper that says, I will pay you money later. plus interest. And so if they sell bonds to the banks pay the Fed in cash. And now the banks have less money to lend out, and so that decreases the money supply. So in order to not get these backwards, think about who's getting the cash in each scenario. When the Fed buys bonds, the banks get the cash, the banks lend that money out, and the money supply grows. When the Fed sells bonds to the banks, the Fed gets the cash, and they pull that money out of circulation because the banks are making less loans. So why do they pick Treasury securities? They really could buy something else in a different market, but the reason the Fed uses the Treasury bill market to increase the money supply is for a couple of reasons. First is that it goes directly into the banking system, which it can be used to boost investment and consumption in the economy, as banks will use that cash to make new loans to businesses, to start up, and to consumers to make big purchases, like cars and homes. And then also is that there is a huge supply and demand for Treasury bills. $500 billion worth of Treasury bills are exchanged daily. So if you want to boost the money supply by a quick $1 million or lower it by a couple $1 million, it really fits into that market seamlessly. There's always people buying and selling these Treasury bills because the U.S. government, it's essentially debt for the U.S. government, and it's a very trustworthy debtor to have. So Treasury securities is that main process. So here just is a little diagram that shows how open market operations work. So here first we're going to look at expansionary monetary policy, an open market purchase where the Fed buys bonds. So the Fed goes to the banks, right? The Fed gets the bonds from the banks, from my financial institutions, and the Fed pays them with dollars, right? The result is going to be more money in the economy because those financial institutions, those banks have new dollars to lend out that they didn't have before. Over here, contractionary monetary policy works the opposite way. So the Fed is going to sell bonds to the banks pay them in cash. Now the banks don't have as much cash to lend out, so there's less money in the economy. So this is the primary way that the Fed will expand and contract the money supply, is through these open market operations. There's this institution called the Federal Open Market Committee. They make decisions like this every day. A lot of times, though, instead of just trying to actively expand and contract the money supply every day when they're buying and selling these bonds, is just to kind of stabilize it, to keep it constant. Depending on banks making a lot of loans, not a lot of loans, they'll try to stabilize it. If the money supply is expanding too quickly or shrinking or what have you, the Fed typically just tries to stabilize it rather than to make dramatic changes, but they can use it to influence the money supply. So with monetary policy, just to summarize, the primary tool the Fed uses is these open market operations. But there are secondary tools that they can use to expand and contract the money supply. First is the reserve requirement, and second is the discount rate. So let's talk about the required reserve ratio. So that's the amount that banks have to set aside and not lend out from their depositors. And if you remember from the money and banking chapter, is that my reserve ratio helps me determine the money multiplier. The money multiplier tells me how many times essentially a deposit can grow as a bank lends out the maximum they can. That's deposited in a new bank that lends out the maximum they can again, on and on and on. So essentially what I want you to know is these ideas right here, is that if the Fed lowers the reserve requirement, we say typically the Fed hangs out at 10%, right? Which means banks can lend out 90% of all their deposits. If the Fed were to lower that to say 5%, now banks could lend out even more. They could lend out 95% of their deposits, and we'll see that multiplier increase. So basically the banks have the ability now to create more loans. So write somewhere, it should be in your concept guide as well, that the lower the little reserve ratio is, the bigger the money supply. So that's one way to expand the money supply, lower that reserve requirement. Vice versa, if the Fed wanted to contract the money supply, they could raise the reserve ratio. So if they raised it to, say, 20%, now banks can only lend out 80% of all their deposits, and they have to have this 20% set aside on reserve. That money multiplier is going to be smaller, and that multiplier process will be smaller. So also put somewhere that the higher the reserve ratio, the lower the money supply. All right, discount rates have to do with discount loans. That's the loan you get directly from the Fed. We said banks typically do not like to get discount loans, but this was the original tool of the Fed, is that the Fed could actually make loans to the banks. And when the Fed made those new loans, the banks could then obviously lend it out and go through that multiplier process. So when the Fed manipulates the discount rate, that's essentially the cost of borrowing for the banks. So this first bullet point, if the Fed were to raise discount rates, that means a discount loan is more expensive. So less banks are going to borrow from the Fed. So they're not going to get a loan from the Fed. And then those banks will decrease the money supply. They're not going to have that extra cash because they didn't go get a discount loan to lend out. Now, if the Fed lowered discount rates, now more banks would go get a discount loan from the Fed, and then they could use that loans to expand the money supply. So, like I said, banks don't really like to get discount loans. They'd much rather borrow at the federal funds rate from one another. So we sometimes say that the Fed is the lender of last resort. A bank will only go to the Fed, go get a discount loan if they cannot borrow from another bank at the Fed funds rate. But still, this is a helpful tool for the Fed to have in a crisis. If a lot of banks are panicking, they're worried about a recession, and they don't want to make loans to even each other because they don't trust the market, they don't trust the economy, this is still a good thing to fall back on. So raising the discount rate contracts the money supply. Lowering the discount rate can increase the money supply. All right. So now we're going to look at basically the results of expansionary and contractionary monetary policy in a countercyclical sense. So before I move through this, I want to jump to this sketch pad here. And I want to basically show you 3 different scenarios and how this aggregate demand, aggregate supply model basically corresponds to our business cycle. So what I have down here is the business cycle. So here I have an economy that's growing over time. That's what this straight line trend represents. But remember, it doesn't happen at a constant rate. There are these expansions where GDP grows really rapidly, and then there are these contractions when GDP falls, right? So it's not a beautiful straight line like this, but we know the economy expands and contracts over time. So based on that, if the Fed wants to counter the business cycle, they can essentially use contractionary and expansionary monetary policy to do that. So here I have basically a long-run equilibrium for a healthy economy. So here at point A, GDP is at the full employment level of output. Unemployment is equal to the natural rate. We've got stable prices. Now, if the economy were to go into a recession, so for example, let's just say hypothetically that a terrible virus has made investors and consumers lack confidence in the US economy. And so as a result, aggregate demand decreases, it shifts to the left. Now we have this equilibrium point B where I've got a GDP level that's below my potential, and I've got high unemployment and a little bit of deflation. That would correspond, that point B is like these red points in my business cycle, right? Because I've got GDP that's lower than kind of that green healthy level that we were just looking at in the last graph. So the goal of countercyclical monetary policy would be to try to boost aggregate demand back to where it started. Try and give the economy a little bit of a boost to kind of push up this business cycle that we're talking about and minimize this recession. And then over here, is kind of the third stage that we can have, or the third scenario, second stage of the business cycle, where I have an economy where there's really high aggregate demand. Maybe aggregate demand's increased because there's high consumer confidence, we're in an expansion, happy economic times. Now I've got GDP that's actually above my potential and unemployment that's unnaturally low. And as a result, I get a little bit of inflation in the economy, right? I've got a higher price level here. So the goal during this stage of the business cycle, it's kind of like these high blue points on the graph, would be to kind of slow down the economy. The Fed would want to use contractionary monetary policy here and try to slow things down, keep that inflation under control. And that's their dual mandate that I was talking about earlier. So during this stage of the business cycle, when we're at point B, the Fed would try to kind of slow things down and bring us back to this stable level here at point A. So we're going to look at how that works in our model. So let's talk about expansionary monetary policy. So if the Fed wants to expand the money supply, we said that would typically happen during a recession. The Fed will typically do that by buying bonds or buying securities. And then a few things happen as a result in the banking system. So the Fed goes to the banks and say, hey, all these pieces of paper you have that say the word bond on it, let me buy it from you. I'll offer you a great deal on them. And they hand the banks fresh new dollars that the banks didn't have before. So the bank takes those dollars, and now there's more money in my banking system to lend out because the banks have all these dollars that they didn't have before. As a result, banks will take those new dollars and lend them out for cheap. So a lot of times you will hear people say the Fed lowered interest rates. This is how they do it. They go to the banks, they say, here's some new money, and then that makes that money cheaper to borrow. When interest rates fall, we get an increase in aggregate demand because we're going to see more consumption and more investment in the economy. The result is we get a boost to our GDP and lower unemployment. So how does that look in my graph? So if we're at this point in our graph and the Fed were to buy bonds or buy securities, we have more money, lower interest rates, and aggregate demand will increase. Right? So aggregate demand shifts to the right. I get this boost to GDP here at Y2. And when GDP is high, we say unemployment is low. And this is a good thing. And we also get a little bit of inflation as a result. So in the short run, I want you to know expansionary monetary policy, its effects on my economy are higher prices or a higher price level. You could also say inflation. That means the same thing here. Higher GDP and lower unemployment. So that's great news. The Fed has a lot of power here to positively influence the economy. So in the short run, expansionary monetary policy is going to increase our real GDP, reduce unemployment, price level is going to increase in the economy a little bit. We're just in the short run, so some of those sticky prices that we talked about haven't quite gone up yet, but some prices that are flexible are going to go up. So this seems like a great result in our economy. The Fed, if they really wanted to, they could just monetize all of the US debt. They could just have the economy, our US government in general could just take over the monetary authority, continue to print new dollars. The Fed could continue to insert those new dollars into the money supply, and we could keep doing this, right? So why don't they just keep printing money forever? Hopefully. The answer to you is fairly obvious, which is that if you continue to increase your money supply over time, you're going to get inflation, and inflation leads to all of these unintended consequences that we see in countries like Venezuela and Zimbabwe and Germany after World War I, is that you can't just keep expanding your money supply on and on and on. While it might give the economy a short boost, like what we saw here, where we have higher GDP and lower unemployment, eventually this inflation is going to get out of control. So basically, expansionary monetary policy in the short run can create a short boost to the economy, but in the long run, a lot of those real effects wear off. So I actually have a great video clip that shows the long run effects of expansionary monetary policy. It is from a show called It's Always Sunny in Philadelphia, which is an excellent show. There is some language in this clip, but it is really hilarious. The premise is that there's a couple of bar owners that try to stimulate their business, their little version of an economy, their bar, by printing currency and adding currency to circulation. And you can see that in the long run, it doesn't do much in real terms for business. So pause this here and give that a watch. I love this clip, and it's a really good example of what the Fed tried to do in 2008, actually. All right, so hopefully you saw the long-term results of an increased money supply. So if you remember, expansionary monetary policy gave us a little bit of a boost in this economy. But if you remember back from the aggregate demand, aggregate supply chapter, topic 3.2, that the long run adjustment is eventually that the short run aggregate supply curve is going to shift the opposite direction of aggregate demand to put us right here where aggregate demand and long run supply intersect. And when that happens, you can see that GDP goes back to where it started, unemployment goes back to where it started, and in the long run, the only effect is I have this higher price level. And that actually makes sense about what we know about how money works. Dollars themselves are not valuable. What's valuable is what you can buy with them. So if you continue to expand your money supply, you're just going to be left with higher price levels or inflation. You don't really stimulate an economy long term by expanding your money supply. So, and this is the results. Basically, monetary policy wears off long term. So we can do the same. We can show contractionary monetary policy in the short run. So this would happen during an expansion. If the economy is expanding really rapidly, the central bank, our Fed, will try to reduce the money supply. So before I click here, think for a second. If the Fed wanted to use open market operations to shrink the money supply, would the Fed buy bonds from the banks, or would the Fed sell bonds to the banks? So the answer is the Fed would sell bonds or sell securities to the banks. So the Fed will go to the bank, say, here's this wonderful piece of paper that says Treasury security on it. Would you like to buy it? And the banks say, sure, that sounds like a great investment. And so the banks hand the central bank cash, right? As a result, that bank, because they bought these pieces of paper that say bond or security on them, they don't have as much cash to lend out. So our money supply is going to decrease. When that money supply decreases, if you want to get a loan, you're going to have to pay a higher interest rate. And people don't like higher interest rates. So when there are higher interest rates on things like getting a small business loan, like getting a mortgage to buy a house, or to a car loan to buy a car, where we see a decrease in the aggregate demand in our economy, both investment and consumption. And the result will be lower GDP and higher unemployment. So aggregate demand will shift to the left, a decrease. And in the short run, here are my results: lower GDP, higher unemployment, but also a lower price level. So we said, why would the Fed want to engage in this contractionary monetary policy that lowers our GDP and ups unemployment? It's this goal. If inflation's getting under control, some trade-offs have to be made, right? In order to lower this price level, because we're in this expansion where GDP is high, we can take the hit, lower GDP a little bit, create a little unemployment, and try to get prices lower again. Long term, short run will shift the opposite direction, and the long run results is I just tamp down on inflation. Eventually, GDP will return to its original level, unemployment will return to its original level. So that's the idea of contractionary monetary policy. All right, so we're going to talk about some flaws with monetary policy. Monetary policy has three main shortcomings. First is that it wears off in the long run. We've already talked about that a little bit, but we'll discuss it a little bit more. The second is this idea called adjusted expectations. And the third shortcoming of monetary policy is its ability to deal with a recession that's caused by an aggregate supply shift rather than an aggregate demand shift. So this little picture here, this guy with the cool gray hair and what is this, a pink tie? This is Jerome Powell. He is the chairman of the Federal Reserve currently. He's kind of the head honcho. He's part of that board of directors that make a lot of these monetary policy decisions. So the first shortcoming of monetary policy are those diminished effects in the long run. So we have a special vocab word for this called monetary neutrality. So monetary neutrality means that no matter what, those two graphs we looked at, expansionary monetary policy, contractionary monetary policy, in the long run, they don't affect any real economic variables. So when I say real economic variables, I mean these two things, real GDP and unemployment. So if I look back at my last two graphs, I'm going to go backwards for a second. Here we had contractionary monetary policy. In the long run, real GDP, which is represented by the variable Y, doesn't change, and unemployment doesn't change. This was true, I'm going back a little bit further, here. Expansionary monetary policy in the long run. Y doesn't change, U doesn't change. The only thing that changes is this price level. So that's what I mean when I talk about monetary neutrality. There's no impact on real GDP, which is my Y variable, or unemployment. The only effect is on a nominal variable, my price level. So this idea of monetary neutrality, the idea that the Fed can't actually grow or shrink the economy long term, does that mean that this is all a useless exercise? And the answer is no. So in the short run, we saw a boost to the economy due to expansionary monetary policy. And in the short run, we saw inflation being controlled by contractionary monetary policy. So remember in the beginning, we talked about how active monetary policy is called counter-cyclical. The idea is that we are trying to counter the business cycle, which by definition is just a short-run change. Now, short run does not mean that it doesn't matter, right? A recession, 2008, that recession lasted months and months. And if you ask someone who's unemployed for 6 months, 8 months, 10 months, if that feels like a short-term economic event to them, the answer is going to be no. Recessions and unemployment can be very painful. So if the Fed can give the economy a short-run boost, even though it might wear off long-term, that's going to matter a lot. So monetary neutrality can be used to kind of criticize counter-cyclical policy, but the whole point is that we'd prefer kind of a business cycle that was more smooth. Instead of these dramatic fluctuations, if instead we could kind of smooth things out and not have these dramatic expansions or contractions, people generally prefer stability over these big fluctuations, and that's our goal here. So even though that is a shortcoming of monetary policy, it doesn't make it totally worthless, I guess is my point. All right, the second shortcoming of monetary policy is if people adjust their expectations. So we say that monetary policy works, or expansionary monetary policy works, because some prices are sticky in the short run. So if we expand the money supply, we're going to get this boost to aggregate demand. The reason is because there are some prices that are staying low. We said some prices are sticky in the short run. Those prices are things like rent for commercial buildings, wages for employees. They don't adjust day to day. So as those prices stay nice and low, when we expand the money supply, it allows a business to maybe hire workers for cheaper, to expand their business, and those prices of their costs of doing business haven't gone up yet. That's why we get this little boost in the economy. We would get this intersection in the short run where we've got higher GDP and lower unemployment. However, if people completely expect monetary policy, if you're a worker and you hear the Fed is going to expand the money supply, hopefully, now that you've gone through this course, you'll know that that's going to lead to inflation. And so you'll go to your employer and negotiate a raise. When you negotiate a raise, we get this shift back of the short-run aggregate supply curve at the same time that we get this increase in aggregate demand. The result will be instead of getting the short-term boost, we just go straight here from point A to point C. right? Because you've already negotiated a higher wage, or landlords have negotiated their leases up. When people have time to adjust to a change in the money supply, we don't have any more sticky prices. And monetary policy or countercyclical monetary policy depends on having those prices. So hopefully that makes sense. Monetary policy, activist monetary policy would be more effective if the Fed did not tell anyone what they were going to do to the money supply before they did it. However, here in the US, we really value transparency and things like that. So this is one theory that monetary policy has become less effective over time because people understand that it's going to lead to inflation later. So we don't even get this short-term boost to the economy. We just go straight to that long run where we just get inflation. All right, third is when a recession is caused by an aggregate supply shift versus an aggregate demand shift. Hopefully at this point, you've noticed that expanding the money supply, changing interest rates, that is tied to investment and consumption, and those are both components of aggregate demand. So if we have a recession that's caused by something like a negative supply shock or a destruction of resources, a long-run shift or a short-run aggregate supply shift, the Fed can't really do much to shift aggregate supply. The money supply is a component of aggregate demand, so they can do things to counteract like a decrease in consumer confidence or a change in foreign incomes, but they can't do things to fix like a supply shock or something like that. This is one of the things that happened in the 2008 recession, is that economists looking back now think that we had a decrease in the long run and short run aggregate supply in this economy. And so even though the Fed did quite a bit to try and boost aggregate demand, it just wasn't enough because there were other things going on in the economy as well. And if you look at both expansionary and the contractionary policy graphs that we looked at earlier, the Fed is only shifting that aggregate demand curve. All right, so that is the first half, monetary policy. Now we're going to discuss fiscal policy. So fiscal policy is a different set of tools used by a different government body to also try and influence the economy. So fiscal policy is the use of government spending and taxes to try and shift aggregate demand. So the Fed is not responsible for fiscal policy. The part of the US government responsible for fiscal policy is Congress and the president. So if you remember watching those Schoolhouse Rock videos back in your government classes in high school or maybe even college, that's the process we're talking about. So this is another group of people who can also influence the economy counter-cyclically, but they use a different set of tools in their toolbox. So if there's a recession or if there's an expansion, you can use monetary policy or you could use fiscal policy to try and smooth out that business cycle. Or you could use both. So for fiscal policy, we need to understand government budgets. So just like you might create a budget for yourself, the federal government creates a budget every year. There is plans for earning income and plans for spending. So the spending portion or the expenditure portion of the government budget is called outlays. So outlays just means how is the government spending money every year. There's two categories, government spending and transfer payments. So we talked about these two back in the GDP chapter. Government spending refers to the government buying a good or service like military equipment or paying police officers or government employees or building roads and stuff. Transfer payments are different. We said those didn't count towards GDP because they just represent the government redistributing wealth from one group of people to another. So those would be things like unemployment insurance, Social Security, Medicare or Medicaid. So we said this counts towards our expenditure approach to calculating GDP, and this one didn't. However, now that we're talking about budgets, the government has to budget for both of these things every year. So now we're going to consider both part of outlays. So within having the transfer payments and the government spending, we subdivide further into mandatory outlays and discretionary outlays. So mandatory means pretty much what it sounds like. The government has to budget for these things every single year because there's a law saying that these things have to go into the budget. So it's determined by an ongoing program. So Social Security, Medicare, Medicaid, unemployment, the food stamp program, all of these things, there are laws in place, and they're sometimes called entitlement programs or entitlement spending. The government can't just decide each year when they create their budget, oh man, we don't have as much money for Medicare this year, so we're not going to budget for it. If they wanted to change the spending for these programs, they would have to change the laws surrounding Social Security and Medicare and Medicaid. So mandatory outlays are mandatory. It's kind of like if you were writing your own budget for a monthly budget, you kind of have to put rent in there, and you don't have a lot of flexibility. Like, oh, I'm going to take a few bucks out of rent this month and put it towards something else. That doesn't really work that way, right? It's mandatory for you to do things like pay your rent and pay your power bill and stuff like that. Discretionary outlays, on the other hand, those are the ones that have a little bit more flexibility. So these would be like the things in your budget, like your entertainment budget, like how many movies you're going to see every month, maybe even your grocery bill. Yes, you do have to buy groceries every month because you have to eat, but you could buy cheaper groceries from Aldi instead of Publix. So you have a little bit more flexibility with this. So the government has these too. So those are decided on every year. So a lot of discretionary outlays include things like spending on transportation, like building new roads and bridges, payments to government workers, so like the salaries that employees are paid. Our defense budget is actually discretionary, so that can fluctuate every year. So it's kind of interesting if you're comparing what part of the government budget is mandatory versus discretionary, and you think about the kinds of things that we expect our government to pay for. A lot of things that come to mind are things like roads and schools and defense, and those are actually the ones that don't technically have to make it into the budget or don't have to be funded as much. The mandatory outlays, things like Social Security, providing retirement and healthcare and unemployment benefits to certain folks that are entitled to them, those are the ones that do have to make it into the budget. So even more surprising than that, mandatory outlays, I want you guys to know, are a growing part of our federal government's budget. So back in the 1960s, you can see of all the total spending, this is our outlays for the federal government. Back in the 60s, discretionary outlays, this is spending on defense and schools and roads, that made up the biggest chunk of the budget, and mandatory outlays were just this little portion down here. Now it's kind of flipped. Mandatory outlay spending on Social Security, Medicare, Medicaid, all of that good stuff is a growing portion of our budget, and then there's less room, right? Less than a third or so of the budget is used for doing things like paying for schools, roads, defense, and all that good stuff. So the reason mandatory outlays keep growing in the United States primarily has to do with our demographic changes. There's a lot of baby boomers who are now becoming eligible for Social Security benefits and Medicare benefits, and so that is putting a strain on the federal budget. And so as more people become eligible for these benefits, there's less money for roads, schools, defense, all that good stuff. So now that we've talked about how the government spends, let's talk about how the government raises funds. Primarily, the government raises funds through taxes. I want you to know that the biggest source of tax revenue, there's all kinds of different taxes the government passes and collects money from, but the biggest source is federal income tax. Those are the little forms that you account for every year by April, and sometimes you get money back. That means that you paid too much in out of your paycheck every month or every week, however often you get paid. And so you're getting some of your federal income tax back once you report it for the year. Sometimes if your employer did not take enough out of your paycheck, you got to pay a little extra in, and you owe at the end of the year. That is the government's single greatest source of tax revenue. And in the United States, our income tax is progressive. So progressive means that as you earn more money here in the United States, on that extra money you earn, you have to pay more in income tax. So if you Google federal income tax brackets, you can see that the higher levels of income are taxed at a higher rate. So that's kind of interesting. Another big source of taxes are social insurance taxes, sometimes called FICA. So those are taxes, they're sometimes called payroll taxes, that go specifically to paying for programs like Social Security and Medicare. So you might see on your pay stub federal income tax, that's subtracted out, and then you might see FICA on there, and that's more tax that's subtracted out of your gross pay, or your paycheck might specifically say Social Security and Medicare tax. So those are the same ideas. They come out of your paycheck. They're payroll taxes. So if you want to hit pause here, I've got this funny clip. If you click this in the supplemental video tutorials, there's this clip of Rachel from Friends realizing how much payroll tax she loses from her gross pay. And I think it's kind of funny. So if you want to hit pause here and go to those supplemental video tutorials, you can see the Friends clip linked there. All right, so income tax, single greatest source of revenue. In second place are these payroll taxes. They both come out of your pay stub. This is also paid partially by your employer. There's other tax sources as well. So corporate taxes on like corporate profits from businesses. There's estate taxes, there's gift taxes, there's custom taxes. Those are like tariffs and quotas. But by far, this is the biggest source of tax revenue for my government every year to then use to spend on all those outlays. So I got this kind of cool graph here that shows of all the revenue the federal government collects over time, how much of that revenue is income tax. You can see it's about half of their money that they get. Corporate profit taxes, people make a lot of fuss about that, but corporate income tax is actually a very small portion of total tax revenue. Whether that should be larger or smaller, I guess, is a political opinion you might have. And then here we've got my social insurance tax. That's Medicare and Social Security. You can see it's expanded over time. Excise taxes, we talked about those. Those are taxes on specific items like cigarettes and alcohol and stuff like that, and then other. The government also collects some revenue, not through taxes, but through things like collecting some fees for going into national parks. But taxes is their primary way of raising revenue to pay for those outlays. All right, so we know how the government spends. We know how they raise income. When we put those two sides next to each other on their annual budget, they can get one of two scenarios here. The government can run a budget deficit in a year. A budget deficit means the outlays, the money they're spending, is greater than what they're collecting in revenue from taxes. So essentially, they are spending more money than they are earning from taxes. And the other scenario is a budget surplus, where they have more tax revenue coming in than they're spending. So they've got extra money to do stuff with. So if you're curious, the U.S. federal government tends to run budget deficits every year. In fact, we haven't had a budget surplus since 2001. So you might be asking yourself, well, how is the government possibly spending more money than it's collecting? The same way you or I could spend more money than we earned in income, by taking out loans and collecting debt. So a deficit represents a type of debt. So a few things about deficits is that they're growing. They're more consistent in the U.S. Like I said, we haven't had a surplus in a very long time. We tend to run deficits every year, and they keep getting bigger. They tend to get bigger during recessions, especially because people aren't paying as much in income tax because they're losing jobs and things like that. And so the biggest budget deficit in U.S. history was as a result of that 2008 recession. It was about $1.4 trillion in 1 year that the U.S. government had to borrow. Now, that being said, 2019's budget deficit is approached a trillion. It was $984 billion. So, this record-breaking deficit might be a thing of the past fairly soon. But it is interesting to look at. So another thing about deficits, you might hear people talk about the national debt sometimes, and you might hear people use the term deficit and debt interchangeably on the news, but they're not the same thing. So a deficit represents 1 year where the government spent more than it earned in revenue, so it's like 1 year of debt. And then the total national debt is all of the deficits added up over time. So you can actually, if you were looking for a depressing party trick, always go to usdebtclock.org. And you can see the U.S. national debt right here. So like I was saying, back in 2019, the debt for the year was something like, 900 billion. Our total debt is over $23 trillion. So here I've got millions, billions. This is trillions of dollars. So this is the total amount of debt the U.S. government owes to different folks. There's also a lot of rumors going around about, foreign entities owning a lot of the debt. Most of the debt the government has is actually owed to itself, like other government agencies that are holding those bonds and things like that. You or I can own some federal debt as well. It's just whoever wants to buy those little IOUs. But if we wanted to pay off the national debt right now, we could split it up. If we could all just chip in $72,000 roughly per citizen. Of course, that includes kids and people who aren't taxpayers. So really, realistically, it would cost about a couple $100,000 per taxpayer. Here is the deficit going over on track to be one of our largest of all time. We got $1 trillion in here, so pretty big stuff. The reason this debt racks up so quickly, you can see we've got tens of thousands of dollars every second. It's growing is because if you have debt, you know that debt earns interest, right? So the longer you hold on to credit card debt, student loan debt, it grows over time. And so the same is true for U.S. debt. So another part of our mandatory outlays is paying interest on the debt. So the bigger our debt gets, the even bigger those mandatory outlays become because the interest racks up even faster. It's kind of amazing to watch. All right, so we're going to talk a little bit about how this ties back into countercyclical policy. So during a contraction, just like with monetary policy, we want to try to counter it. So if we're in a recession, we're in a contraction, we would try to use expansionary fiscal policy. So expansionary fiscal policy means trying to increase aggregate demand. So as a reminder, aggregate demand has an equation, C plus I plus G plus NX. So when the Fed expands the money supply, they try to boost investment. When the government, Congress, and the president try to use expansionary fiscal policy, they're going to try to boost government spending and boost consumption. So there's two ways they can do that. One is pass a bill going and passing new government spending, so doing things like public works projects. If you're familiar with the New Deal back during the Great Depression, building the Hoover Dam, stuff like that, that's the theory behind it, is boosting some government spending on goods and services. And they can also decrease taxes. So decreasing taxes is what actually boosts consumption over here. So if you remember from the aggregate demand, aggregate supply chapter, we said lowering taxes means you have more money in your pocket, so you have more money to do things like go buy a new car or a new laptop. So lowering taxes and raising government spending is expansionary fiscal policy. So we think about how that relates to the debt. That's why those deficits grow so much more during recessions. So if I wanted to boost government spending by an extra $500 billion, we're going to have to borrow even more than $500 billion. The reason for that is if we're in an economic contraction, people are losing their jobs. People are having their hours cut, just like right now during this coronavirus, right? We are not paying any income tax because some of y'all's paychecks have stopped altogether, right? So the government is not earning as much revenue right now as they have in the past because unemployment's going up. So if the government's not earning as much revenue, if they want to give this economy a boost by coming up with an extra $500 billion of spending, the deficit has to rise by more than that because they have to make up for all this lost tax revenue in addition to finding an extra $500 billion to spend and trying to boost the economy. And so that's why, if you've been following some of this coronavirus news that's going around, people are talking about this spending bill and how expensive it is and what it'll do for our debt and deficit this year. So this is kind of just a summary of the different types of countercyclical fiscal policy that the government could take place. So when we're in a contraction or a recession, the fiscal policy that's expansionary would be to boost government spending or lower taxes. Boosting government spending affects the G category of aggregate demand. Lowering taxes boost consumption of aggregate demand, and that leads to bigger deficits and more debt. During expansions, the idea is the government should lower some of their spending and up the taxes so they can use some of that money. It'll lower aggregate demand, but they can use it to pay down the debt. So hopefully slow down that debt clock we were looking at earlier. And now, like I said, in recent years, despite the many expansions, our deficits keep growing. So history is proving that this isn't very common, but that's the way theoretically it's supposed to work. So just like with monetary policy, fiscal policy has a couple of shortcomings. The two main shortcomings are time lags and crowding out. So I'll explain both of those. So there are three types of time lags. So this is a shortcoming that is unique to fiscal rather than monetary policy, because monetary policy can be enacted to counter the business cycle pretty rapidly through that Board of Governors and the Federal Reserve. So with fiscal policy, it's a little bit trickier. There's three types of lags that slow down fiscal policy. The first one is recognition lag, which just means it takes us a long time to realize that we're in a recession before we can decide to do something about it, right? So GDP data, we say, it takes a long time to collect. We talked about that long drawn-out process in that GDP topic. We talked about how unemployment data can lag and how sometimes unemployment can actually get worse as a recession is ending, as some discouraged workers re-enter the workforce. So the first lag when it comes to fiscal policy, or really any sort of countercyclical policy, is just figuring out what stage of the business cycle we're in, because we don't have perfect information. That's recognition lag. Second is implementation lag. So this is talking about the political process. So with fiscal policy, especially with coronavirus, they tried to pass a stimulus bill one time, but Democrats and Republicans could not agree on it, and so it died in Congress and then had to be renegotiated, go through committees. There were compromises made before they could actually get something passed through Congress and for it to land on the president's desk to sign. So that's implementation lag. It's just the fact that the political process is really slow, whereas monetary policy can take place rather quickly. The political Congress and legislation, that whole process takes a lot more time, a lot more negotiation and compromise. And then the third lag is impact lag. So just taking this coronavirus stimulus bill as an example, now they've passed this, I think, $2.2 trillion spending bill, the one where everyone's supposed to get a $1,200 check. It's going to take a while to actually put that stuff into practice and for the economy to respond to that stimulus. So the result of all these time lags is that a lot of times, instead of smoothing out the business cycles, we can actually make things worse. So here's what I mean by that. So we talked about with monetary policy, the goal is to kind of slow down expansions, right? Push these peaks down and give a little boost during these recessions, right? So you really got to time out when your policy hits. So if I am trying to implement fiscal policy, that gets even harder with my time lags. So let's suppose we're at this point in time. We'll call it T1. We can see this is an expansion, right? So if I'm trying to implement some counter-cyclical fiscal policy, I'm going to try to raise taxes and lower government spending to try and push down this expansion, right? But if by the time I recognize it, go through recognition lag, get my bill negotiated through Congress, feel the impact lag, if enough time has gone by for all of those lags that I'm at this point in time, now I have this policy that's supposed to slow down the economy hitting when I'm already at a recession, right? And vice versa. If I'm at this point in time, T2, I can see the economy needs a little boost. So I want to expand government spending and cut taxes. If by the time I get to through my lags, I'm at this point, now I've given an expanding economy even more of a boost. So instead of kind of smoothing out the business cycles like this dotted line here, I might actually accidentally end up making my business cycle really dramatic, which is what we don't want, right? It's the opposite of countercyclical. We can make the economy very volatile, and typically people don't like that. So that's what I mean down here when I say time lags can be destabilizing. Got to watch out for that. All right, third is the idea of crowding out. This means that aggregate demand and fiscal policy might not be as effective because the government can crowd out private industry. So the best way to explain this is with an example. So here, when I think about expansionary fiscal policy, say aggregate demand, I'm trying to boost aggregate demand, right, to expand fiscal policy. And the way we do that is by boosting government spending. That's the goal. And we said that the government, in order to boost their spending, typically has to borrow a lot of money in the economy. So when the government borrows, they go to the same industry that a private business would. They go to the market for loanable funds. And if the government is borrowing a lot of money, that's going to raise interest rates. Raise interest rates, little I. Or that's not right. Little I is not interest rates. Raise R for rates. So when interest rates rise, that slows down the investment in the economy and the consumption in the economy. The reason that happens is because I don't want to go get a new mortgage or get a new car loan if interest rates are going up. And the government has basically pushed up those interest rates because they're looking to borrow a ton of money to boost their government spending. And so there's not as much to go around for someone who wants to buy a new car or for someone who wants to get a small business loan or expand their business and make some new capital purchases. So a lot of times this shift in aggregate demand can be completely canceled out because the government, in trying to boost government spending, actually slows down investment and consumption because they've raised those interest rates. So we say they crowd out the private economy. So overall, aggregate demand may not shift at all, and the only result is the government has all this extra debt now. All right, so this is the last slide. The good news is our economy has automatic stabilizers tied to fiscal policy. So these are government programs and policies that naturally implement. So it kind of gets around the issue, at least of time lags, to counter our business cycles. So automatic stabilizers, we don't have to worry about impact lag. We don't have to worry about implementation lag so much because they're already built into our system. So a good example of this would be our progressive income tax rates. So I said earlier that as you earn more money, it's taxed at a higher rate. So if we're in an expansion, for example, and people's incomes are rising, so if incomes are rising, we're in an expansion, they're going to have to pay more in taxes. And so that's naturally going to tamp down on some of the expansions in our economy, right? As GDP is rising, people's incomes are rising, they're going to have to pay more because we have progressively higher income rates, and that slows things down. Vice versa, in a recession, incomes are falling, they're going to fall into a lower tax bracket, and so they kind of get that tax cut. And so that can give the economy a little bit of a boost during a recession. So that automatically implements, right? Republicans and Democrats don't have to come to an agreement on this. It's already built into our system. That's why we call it an automatic stabilizer. Same thing with corporate profit taxes. Corporate profits are higher during expansions. That's a bigger overall tax bill. They're lower during recessions because businesses are struggling. So that's a lower overall tax bill. And so these are tied to government spending. So government spending on things like unemployment insurance are going to go up during recessions, right? Because more people are losing a job. So that naturally boosts some of the spending by the government. And less people need unemployment insurance and unemployment compensation during an expansion. So that naturally lowers government spending. And then other welfare programs as well, things like food stamp programs, housing stipends. During downturns, the government spends more on those programs, and the governments don't need as many of those programs during expansions. So these automatic stabilizers, they kind of help us go to this dotted line here. They help us smooth out the economy. We don't have to worry about them destabilizing as much. And that's all I've got for fiscal and monetary policy. Let me know if you have questions.